Getting started with investing can initially feel overwhelming, given the vast landscape of options available. However, you can make things easier by embracing time-tested strategies. In this video, we'll explore the top 5 investment trends for beginners, delving into both their benefits and potential risks. But before we get started, take a moment to give this video a like and subscribe to our channel. Be sure to also hit that notification bell so that you won't miss out on any of our upcoming videos. Number 5. Invest in stocks. Buying stocks in individual companies presents both risk and potential rewards. It can be a lucrative option, but it's important to assess whether it suits your investment goals. First, consider if you have a long-term investment horizon, typically spanning at least 5 years. Additionally, ensure that you possess a good understanding of the business you intend to invest in. Stock prices fluctuate constantly throughout the trading day, which can lead people to adopt a short-term trading mindset when they own individual stocks. However, it's essential to remember that when you buy a stock, you acquire a partial ownership stake in a real business. Over time, your financial well-being will be closely linked to the performance of the underlying company you've invested in. Number 4. The buy and hold strategy. The buy and hold strategy is a timeless and proven investment approach. In simple terms, you buy an investment and keep it for the long term, ideally for 3 to 5 years or more. This strategy encourages you to think like an owner, promoting a focus on the long run rather than engaging in active trading, which can harm your returns. The key advantage of this approach is that it relies on the performance of the underlying business over time. By committing to never sell, you can avoid capital gains taxes, which can significantly impact your returns. Unlike active traders who constantly monitor the market, buy and hold investors enjoy the freedom to pursue their interests without being tied to market fluctuations. However, there are risks involved. Success with this strategy requires the discipline to resist selling when the market experiences downturns, which can be challenging. The market can undergo substantial declines, including the possibility of a 50% or greater drop, and individual stocks may experience even more significant decreases. Staying the course in such circumstances is easier said than done. Number 3. Invest in index funds. Investing in index funds is a straightforward and effective strategy. It involves selecting an appealing stock index, such as the S&P 500 or NASDAQ Composite, and purchasing an index fund that tracks it. These indexes have a lot of the market's top stocks, offering a well-rounded investment, even if it's your sole investment choice. Instead of trying to outperform the market, you simply align your investments with the market through the fund, enjoying its returns. The benefits of this approach are significant. When combined with a long-term buy and hold mindset, it can yield excellent results. Your returns mirror the weighted average of the index's assets, and a diversified portfolio lowers your risk compared to holding just a few stocks. Moreover, you're spared the need to analyze individual stocks, making it a low-effort investment choice that frees up your time for other enjoyable activities while your money works for you. However, there are risks associated with investing in stocks, even when owning a diversified portfolio. To achieve the market's long-term returns, like the S&P 500's average annual return of around 10%, you must weather the market's challenging periods without selling. Keep in mind that by buying a collection of stocks, you'll get their average return rather than the highest performing individual stocks. Nevertheless, it's worth noting that even many professional investors struggle to outperform these indexes over time. Number 2. Income investing. Income investing involves owning investments, such as dividend stocks and bonds, that generate cash payouts. These payouts can be used for various purposes, or reinvested in additional stocks and bonds. Income stocks offer the advantage of potential capital gains in addition to cash income. A notable benefit of income investing is its simplicity, as you can easily implement this strategy using index funds or income-focused funds, eliminating the need to select individual stocks and bonds. Income investments tend to be less volatile than other types of investments, providing a consistent cash payout. High-quality dividend stocks often increase their payouts over time, boosting your earnings without extra effort. However, there are risks to consider. Income stocks, while generally less risky than stocks, are still stocks and can fall. If you invest in individual stocks, they may reduce or eliminate their dividends, resulting in no payout in capital. Bond yields may not always be attractive and could fail to keep pace with inflation, eroding purchasing power. Additionally, owning bonds and dividend stocks in a regular brokerage account may entail tax obligations, making it advisable to hold these assets in a tax-advantaged retirement account like an IRA. Number 1. Dollar cost averaging. Dollar cost averaging is a straightforward and low-risk approach to enhance your investment returns as well as a great way to practice buy and hold investing. This method involves regularly adding funds to your investments at fixed intervals. For instance, investing $500 each month or $125 every week, regardless of what the market is doing. The advantages of dollar cost averaging are evident. Spreading out your buy points shields you from the risk of dumping all your money in at once. Instead, it ensures that you acquire an average purchase price over time, reducing the likelihood of buying when prices are too high. Moreover, this strategy promotes discipline in your investment approach, potentially leading to the growth of a larger portfolio over time. However, while dollar cost averaging safeguards against investing all your money at the wrong time, it also means you won't fully capitalize on the best market opportunities. Consequently, you might not achieve the highest possible returns on your investments. Before you begin your investment journey, it's essential to assess your risk tolerance and define your financial objectives. Understanding these factors is crucial before you invest your money. Don't forget to give this video a like and subscribe to our channel. Make sure to hit that notification bell as well if you don't want to miss out on our upcoming videos.